For perspective, let's bring in Sarah House, senior economist at Wells Fargo. Sarah, when you go through some of the meeting minutes, you can clearly see that Fed members are trying to reconcile their view with what the market has been pricing in, as many as 6 or 7 rate cuts so far this year.
Right. So I think what we saw is that overall Fed officials remain weary of cutting too early rather than being too late on it. So they still rather err on the side of bringing inflation back down. So I think that's the most salient point to take away from these minutes. But that's not to say that they haven't seen improvement on the inflation front. So we did see some acknowledgement of that as well, including across different components. But at the end of the day, as we heard from Chair Powell, they just need to see more of that.
Well, and we didn't see that, right, as of our last reading of consumer inflation and producer inflation. How did that affect your thinking when it comes to the trajectory of rate cuts?
Right. So heading into the January data, so not just the inflation data, but also the labor market data, we were looking for that first cut to come in May. But I think just given that strength of inflation and that we haven't seen that broad-based deceleration that we were seeing in the final months of the year, that along with the strong jobs numbers that we saw, I think it does point towards the Fed likely beginning to start that easing cycle somewhat later. So right now markets are priced for that first cut to come in June, which I think seems pretty reasonable based on the most recent data, as well as how many reports that we'll have between now and then. So we'll get 4 more reads on the Fed's preferred measure of inflation, as well as 4 more employment reports.
What about other tools that they can use, namely ending quantitative tightening or beginning to taper that off? Do we get greater insight into whether they're thinking about it or whether they're beginning to think about thinking about it?
Right. So we did learn at the press conference, Powell said that they were planning to have an in-depth discussion of that in March, and that showed up in the meeting. So we don't have a lot of details on what shape or form that's going to take or the timing, but it does seem that that conversation is moving forward with that in-depth discussion coming in March. So I think that the progress in terms of stopping QT is at least in the works, and so we'll see more about that in the next meeting, the next press conference.
There have been issues of not necessarily financial stability, but certainly regional banks that have been in distress. New York Community Bank has been one of them. Obviously, the Fed was able to effectively ring-fence the issues with Silicon Valley Bank without derailing their rate hiking campaign. Do you get a sense that they feel that they can deal with any instability in the financial markets in a similar fashion?
So I still think that they're looking at the supervision part of this somewhat separately, and I think they do consider the fact that they have gotten this far with rates where they are without seeing broad-based spillover effects, that they're not worried about that financial stability side. And in fact, we did see that portion taken out of the last statement, even though I think there was some mismatch there in the timing with the news of New York Community Bank just coming out that morning. But I think overall, this is in some ways to be expected of some of the long tails of that tighter policy, and not being fully able to understand or say with certainty what some of the lags of those higher for longer rates are going to be on the broader based outlook.